The European Central Bank is sounding an alarm about artificial intelligence, and when a major central bank raises a formal warning about a specific sector, markets pay attention. The ECB, which sets monetary policy for the Eurozone and monitors financial stability across Europe, published analysis cautioning that assets tied to artificial intelligence may be dangerously overvalued. The core concern is straightforward. Investor enthusiasm for AI may have pushed prices well beyond what the actual economic fundamentals can support. This is not a casual observation. Central banks do not flag potential corrections lightly. Their financial stability teams spend months tracking asset prices, debt levels, and stress points across the global system. A formal warning from Frankfurt signals that policymakers believe the AI-driven run-up in certain assets deserves serious, careful scrutiny. The pattern the ECB is describing has appeared before in financial history. A transformative technology captures the imagination of investors. Capital rushes in. Valuations climb sharply, often far ahead of real revenues or profits. Then expectations meet reality, and prices reset hard. It happened with railroad stocks in the 19th century. It happened again with dot-com companies in the late 1990s. That history does not guarantee AI follows the same path. But it does mean the risk is real, and ignoring it is not an option. For global markets, this warning carries extra weight because Eurozone banks and large institutional investors hold significant positions in technology-linked assets. A correction in AI-related stocks or bonds would not stay contained in one region. It could move through credit markets, hit pension funds, and drag down broader equity indexes around the world. The ECB's move also puts pressure on peer institutions. The US Federal Reserve and the Bank of England both carry financial stability mandates of their own. When a major central bank publishes a formal sector warning, other regulators tend to follow with their own reviews. Analysts will now be watching closely to see whether Washington or London responds with similar guidance. The central question remains unresolved. Will AI companies generate enough real earnings growth to justify where their valuations sit today? Or will the gap between price and fundamentals eventually force a painful reset? No one can answer that with certainty right now. What is certain is that one of the world's most influential financial institutions has put that question on the table in a very public way. For investors holding exposure to AI-linked assets, whether through individual stocks, technology funds, or broader index positions, the ECB's warning is a reasonable prompt to revisit how much of your portfolio depends on AI growth expectations being fully realized. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.